Hi everyone, let's go over my bullish and bearish Elliott wave scenarios on Bitcoin. In this video will be more of a summary, shortly covering the weekly, daily and the 4-hour time frame. Starting on the weekly with the bullish scenario where we are looking for an impulse to the upside, 1, 2, 3, 4, 5. Common target for your wave 4 is hit 57.1k to 42.8k, in validation 37.7k. And after a wave 4, we want to see a 5-wave impulsive structure up in a wave of 5. Target area 81.3k to 129k. After this wave 5, we then look for a bigger retracement towards the downside, and if you want to know more about that, click the card at the right top of your screen. Now we have hit important support here on the chart. These are volume profile levels. If you take a volume profile of this range in 2021 and the start of 2022, you'll get the value area low, point of control, value area high. Nicely respected in the past, resistance, support, breakout, and now retesting as support. Would be important for the bulls to hold this level. You don't actually really want to go back in this range, especially coming back in retest and break structure. Increases probabilities to move to the point of control, which pretty much would invalidate the bull market. Therefore, for the bulls, it is actually important to hold this low. Now the bullish scenario would be an ABC zigzag ending this wave C here on top of that important support and also on a high amount of volume. If I quote Elliott Wave International, then it is quite common for corrective structures to end on a high amount of volume and then reverse to continue the trend. We definitely here have a wick on a high amount of volume, and preferably for the bulls, that is your low and you look for upside. The invalidation is of course very easy because that is taking the low at 49k. Now that means that for the bulls, we want to see one of 3 impulsive structures on the lower time frames, which is either a diagonal that I have on my chart here, an impulse, or a multi 1-2. Now this diagonal means that we have a 3-wave structure in a wave 1, a 3-wave structure in 2, and then a 3-waver in 3, 4, 5, ending a wave 1. Usually you get a deep retracement in a wave 2 after a leading diagonal, and then you look for continuation to the upside. Now all of the structures have to be zigzag family structures, so a zigzag in 1, double zigzag in 2, preferably would be finished in that case. Look for another 3-wave up and then zigzag, zigzag, and then you get the retracement in your wave 2. Your hard invalidation is 49k. Arguably your soft invalidation would be taking out this low, as that at the moment would not really be preferred at 56.2k. Your most bullish scenario is a multi 1-2, 1-2, 1-2, 1-2. Now this is a triple 1-2. We can make it a double 1-2 in case price does move below the blue invalidation at 57.8k, because then we can have a blue 1 potential sort of a flat structure or complex structure in 2 and then continuation up. Your hard invalidation really is taking out the low at 56.1k. It does mean that we have to count this structure to the upside as an impulsive move and not a 3-wave structure. And of course, on a 4-hour, 1-hour time frame, you can clearly see we have a 3-wave structure. But in a live stream last week, and also with the count of SV1234 in Discord, yeah, there is a potential possibility of counting this somewhat an impulse and then a wave 1, 2, 3. This is your 4 and then a 5. It is, however, uncommon for a wave 4 to be shorter than wave 2, and it remains an awkward structure to count as an impulse, but in that case, you then have your wave 1, 2, 1, 2, 3, 4, 5, 4, 5. That would then be the way to count that structure to the upside as an impulse, resulting in the wave 1 that you see here on my chart, and then you're going to be looking for price to move up in a wave 3, followed by a couple of 4 5s to then eventually finish the green 5 here and then get a retracement towards the downside. If we go back to the weekly time frame, every Elliott wave analyst always needs a bullish and a bearish scenario. The bearish scenario being here a bigger 3-wave corrective structure, after which we expect continuation to the upside. On the chart, I preferably first look for a WXY because the target is simply higher for wave Y, 30.4K, trend-based sub-extension taken from the start to the end of W to the end of X. But there's also the possibility at least for a flat, which then is a 3-wave A, 3-wave B, 5-wave C, where preferably you move below a 15.4K. And currently we are at 60K, well 59K. So I prefer to first look for wave Y, and by the time if price does comes down and we look for a bear market, we will have a much better idea of what the structure is and then what the probabilities are to continue down to 15.4K. But at the moment, not yet really the highest probabilities on a weekly time frame. On the daily time frame, your most bearish scenario, this would be a wave C to move below a 15K, is what you see on the chart here, where you have a leading diagonal in a wave 1, 3 wave 2, another 1, 2 continuation down. What lowers the probabilities is that this wave 2 hit the 886 Fibonacci taken from the start to the end of 1, which is a very rare target for a wave 2 and significantly lowers the probabilities for this to be an impulsive structure to the downside. It increases probabilities that what you see here is corrective, which in turn increases probabilities to still take the highs. Nonetheless, in this case, we then look for another 1, another 2, and continuation down, where preferably based on the local structure here, which we're going to talk about in a second, we still take the high at 63K once more, move up a little bit further in the common target area for 2, which is the blue box here, 62K to 65.5K, and then look for significant weakness and price to move down. In validation, the high at a beautiful level is 70K.00. Very nice, Coinbase for you. So here, this is the second bearish scenario. Even lower probabilities, really, because here we have a wave 1, 2, 3, 4, and a wave 5. This is a leading, expanding diagonal, which is incredibly rare. Expanding structures in general have very low probabilities unless all of the other scenarios fail. I just wanted to show it to you because it is something that I do see here and there. I just wanted to talk about it. Now, in this case, you can label this expanding diagonal as a wave A or as a wave 1, look for a 2 or a wave B, and then a C or 3 to the downside. It's the same structure. Preferably in B, you still have your WX and then a Y, move a little bit higher, and then you move towards the downside to take the low of wave A at 49K. Now on the 4-hour time frame for the bears, we therefore want price to move towards the downside. And if we have a finished 3-wave structure to the upside here, then the most bearish scenario is another beautiful expanding diagonal here. 1, 2, 3, 4, and then you have wave 5. Again, it is very rare, never preferred unless all of the other structures fail, but it is important to at least be aware of these scenarios, right? Because it is important for risk management, even though it doesn't have a high probability from a risk management point of view, especially if you would take out this low, right? There is the potential of continuation, which means that if price moves down to, let's say, the support at 55, you want to wait, no financial advice, you do you, but I want to wait for price to hold this level, change structure, look for bullish CVDs, look for support resistance flips and that sort of stuff, because I am aware of the potential of continuation. Now coming down here also still has bullish scenarios, by the way, so therefore this area is a mix. It's bull and it's bear. I want to observe the reaction first. So it's all about being aware of the potential, where you have your wave 1, 3, wave 2, and you look for continuation down in a wave 3, where then preferably you're going to be looking for a couple of 1-2s and then down you go, making new lows. Your alternative bearish scenario here, actually arguably your higher probability, not alternative, but higher probability scenario would be a zigzag in wave W, any corrective structure in wave X, and then move up inside your wave Y, where at the moment the minimum target for your Y is still above your wave W at 64.6K, which would be a minimum target for your wave Y. And this wave X, yeah, we can finish it over here with a double zigzag WXY, but if you have seen my video of last night, where pretty much I brainstormed this whole range here in like 6 or 7 different scenarios, then you also know that price can still come down to 55, find support, and still move up for a wave wide to the upside. But that is also why that 55K area is very important, as that is a decider for bulls as well as the bears. And that is why if price comes down there, I'm going to be incredibly patient. Looking at the CVD divergences, we have the bullish CVD divergences here in green. We have the bigger bullish CVD divergence, higher low in price, low CVD target is the high. Now you can see that price has enough space to the downside still to keep the bullish CVD divergence in case price does move down to 55 as an example. Locally, we had bullish CVDs here. These already played out because price took this high. I just wanted to show you that there was another bullish CVD. Then over here, price moved up, came back down, creates another bullish CVD divergence. But as price is moving to the upside, also supported a little bit by bullish CVD, we do have some bearish CVD divergences coming into play as well. Lower high on price, higher high on the CVD. Now what I therefore like to see for the bearish CVD divergences to increase in probabilities is seeing a local market structure change on a 15, 3-minute time frame. Those are the two I like the most. But at least see price move towards the downside and continue with bearish local CVD divergences. And only then do I really add probabilities to the bearish bigger CVD divergence, which then basically means taking out the low, because the target of the bearish CVD is price taking out the low here. Now the reason to look for that structure to the downside with additional bearish CVDs is because over here we had bullish CVDs and over here we had bullish CVDs as well, and with this wick and price moving down, we still have some bullish CVDs here. However, for the bulls, it is important now to also wait for structure, because after a swing failure pattern, right, CVD divergences with a pivot before and after the swing failure pattern is less trustworthy. So in other words, I prefer, with regards to CVD, to only now look at this piece of price action. Whatever is going to form after the wick that we made is most important to me. And based on the local range, 3, 5, 50-minute time frame, the structures, continuous bullish or bearish CVDs, I can make better decisions. Now we also have some news today, so make sure you trade safe. 8 p.m. Central European Time, FOMC minutes, so it might increase some volatility. And if we then finally look at the probabilities of the different scenarios, then on the weekly time frame, probability is higher for the bulls than the bears. On the daily time frame, in both the bearish and bullish scenario, we preferably look for another local high above 63K and then take it from there. However, context-wise, we made a high volume low for a potential end of a wave C on important weekly support. So that narrative is at least interesting for the bulls. What's not too great for bulls is that a 3-wave looking structure to the upside, but that is why I write that preferably we take the high at 63K, which is also based on local probabilities, and then we observe, right? And based on the reaction to the upside and price moving to the upside, we can eventually analyze the chart again and get to the probabilities. On the 4-hour time frame, highest probability is to still take 63K at some point, as the probabilities are higher that this is a corrective structure, not an impulsive structure. And then again, we continue to observe. And on the 1-hour time frame, the probability is also higher to take 63K first, instead of price dumping to the downside and taking out 49K. I wouldn't have a problem with that to happen. This is Elliott wave probabilities for you. An expanding diagonal is simply incredibly rare, but of course it is a structure, but it is definitely not a high probability scenario. And in the end, that is the only thing that we can trade. So that being said, I hope that this video was helpful or valuable to you. Please check out the brand new complete Elliott Waves guide playlist I've made that shows you all you need to know about Elliott Waves. Thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.